My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'm doing my friends. I'm just trying to make a little money. My job, not just to entertain you, but to put days like today in context, because they are nutty. So call me, 1-800-743-CBC. Tweet me at Jim Cramer. The bond market is really screwing things up here. Bonds are wrecking the narrative, driving the people out of everything that works when the Fed cuts rates. And they're going right back into tech. That's the opposite of what, if you're a true bull, you want to see. So even though the Dow only dipped 155 points, this would be advanced 0.16%. But, of course, the NASDAQ jumping to a record close, gaining 0.78%. The market's getting narrow again. It's getting uninclusive, meaning it's not healthy, because the winners are more narrow and concentrated, mainly in tech and not much else. See, if the bond market doesn't start behaving, or at least calming down, if longer-term interest rates don't stop going up, we're going to start losing the groups that have led us higher for months now and go back to our bad old ways with just a couple of magnificent ones. In some ways, you know what, this was predictable. When we got wind that the Fed was going to bless us with that 50 basis point double rate cut, people went nuts. They're trying to buy bonds. They were betting that they would have a rapid, remember, we're going to have a rapid series of rate cuts this month, this month, this month, this month, where the Fed would push down bond yields. It seemed a totally legit thing, right? I mean, the economy is slowing. That's been the pattern historically. Inflation was receding, so history was supposed to be repeating itself. But then after that darn double cut on September 18th, we saw something that hasn't happened since 1995. We saw long rates go higher, not lower. It was a total buzzkill, and we're beginning to feel it with earnings now. Today, D.R. Horton, they make affordable homes. It absolutely imploded. The company reported a very big shortfall, even though Horton's a great operator, largely because mortgage rates are a lot higher than we'd expected. You know what? We got the same kind of action from a charitable trust, and this was painful. Stanley Black & Decker, the tool company. Anything remotely related to these companies saw their stocks just get obliterated today.
The House of Pain.
Now, housing is only 10% of the economy, but as I always say, when it comes to the S&P 500, housing punches above its weight. It has tentacles in banking, thanks to all those mortgages and home equity loans we expect to be made. It has fingerprints in retail, because you go to the store to rehabilitate and to renovate. It has its paws in electronics, including computers, because you might be inclined to deck out a home office when you move. Oh, there's so much to housing. Plus, we don't know when these long rates will stop climbing. Now, I think that the rates are still low as it is, but the velocity is crazy. We have two presidential candidates that want to spend more than we take in. One, I'm talking about taking in not much revenue besides, unless it's from tariffs, which would be terrible for trade. We got bond auction after bond auction, seemingly endless supply of all vintages of treasuries. All you ever is, hey, we had another auction. Yeah, I used to be an auctioneer. Let me tell you, we don't want this many auctions. So what happens to the rest of the stock market when the bonds keep getting crushed like this? Well, first we go back to the stocks of companies that have very little exposure to interest rates, namely tech. We got this unbelievable set of numbers last night from some outfit you haven't heard of, but I studied pretty closely for the last 30 years, called Cadence Design Systems, an incredibly good semiconductor design software company. Goes arm in arm with NVIDIA. It sent the whole groups flying. Can it stay up here? Well, it's mighty hard because not every tech company is going to be as rosy as Cadence. For instance, AMD. AMD reported a strong set of results this evening, partially fueled by demand for their AI chips, the only ones that come close to NVIDIA's. However, they also gave you some not-so-hot guidance for the current quarter because they're worried about supply constraints. The demand for these chips is off the charts, but they may not be able to make enough of them because there's only so much high-end semiconductor capacity worldwide. Now, to me, silly little me, that seemed like a high-quality problem. But it's a problem nonetheless, which is why the stock got slammed in after-hours trading. It makes it imperative that you watch Squawk on the Street tomorrow morning when we speak to AMD CEO Lisa Su about these numbers and her commentary. That's called promotion. Alphabet, on the other hand, reported an unambiguously fantastic quarter. And now to Ashkenazi. I told her she'd be good. The CFO, she used to be over at Lilly. They report tomorrow. I was worried about Alphabet because there's so many moving parts, and the stock gets stings so often when the core results are pretty good, although we still own it for the charitable trust. This time, Alphabet handily beat the estimates. Big numbers from Google Cloud Business. I like that guy who runs that anyway. And strong ad sales for search and, yes, YouTube. Just an excellent quarter, one that allowed the stock to roar in after-hours trading, even though it had already run up into earnings. Very impressive. Oh, and if you stick with us later in the show, we're going to speak to actually the star of tonight's trading, which is Steve Huffman. He's the CEO of Reddit, with a stock that is just going nuts in after-hours trading. Just a monster earnings report for this one-time profitless internet hub. You know what's really a shame? This session should have been just terrific. Terrific, because far away from housing and bonds and tech, we witnessed a miracle of capitalism when Goldman Sachs priced 112.5 million shares of Boeing at $143. That's a more than 5% discount to where it closed the night before, raising $16.1 billion. It was the largest follow-on deal since the federal government dumped its AIG stake back in 2012. Sold to you. Boeing also raised a slug of money in the bond market. Get a total of $21.1 billion, enough to tide over the company that's losing $1 billion a month. Monumental achievement reminiscent of a different time, the depths of COVID, when Boeing sold $25 billion in bonds in April 2020. That basically was when we realized the pandemic was not going to ruin our economy. Today's equity offering means that Boeing's viable again. There's no longer a chance that it becomes a ward of the state, even if the striking machinist union continues to play a high-risk game of chicken with management over wages. Now that Boeing has enough money, it's finally got the leverage against the union, and that means there'll be a deal soon. Once that happens, they can go back to making complaints. They used to do that. They can do it again. The deal is dilutive. I get that. But one of the most pressing overhangs in this market has now been removed from the bearish equation. Boeing stock's free to go higher. It may be much higher if CEO Kelly Ortberg can execute. I love miracles of capitalism. This is one of them. But against that is this stupid bond market. If it doesn't stop its retreat, then we're going to start questioning the idea that the Fed will keep cutting rates, ushering in a fabulous economy for 2025, which is what I was looking for. Bottom line. If interest rates don't stop their quick rise, they can go up slowly. I get that. But the quick thing, what's going to happen is we're going to go right back to the same old, same old. I'm promising you this. We're only a very few big tech stocks we're winning, and many more we're losing. In other words, we're on the verge, if the bond market doesn't calm down, to what I can only describe as an extremely suboptimal situation. Why don't we go to Tom in Florida? Tom.
Hi, Jim. Thanks for having me on.
No problem, Tom. What's up?
I've been an investment club member for a couple of years now. I just renewed for another 2 years.
Thank you, man. Thank you. You know the angst I have, like the Stanley Black & Decker. I said, well, maybe everyone's just going to cancel. I always say that. Everyone's going to cancel. Now, do you know that for 42 years I've been saying everybody's going to cancel? When am I going to learn that they don't cancel? But it's okay. Got to stay humble. What's shaking?
Yeah, well, I still want to make money, and I'm trying to figure out my own risk tolerance. Could you please help me understand what's happening in the Chinese market as it relates to
Sure.
Alibaba?
It's a giant fraud. It's a ridiculous situation. They decided to buy stocks, keep them up, in order to be able to stay overweight in the MSCI. Fraud's too strong a word. How about leisure demand? You know that leisure demand? That's what they're doing, a little leisure demand. And I get tired of it. Every morning I come in, it's like, oh, Baba's up because they announced some stimulus. You know what? They ought to just announce a new economy. And I would start it with a new CEO of China. That's right, a new guy. All right, if rates don't behave, we are going to begin to lose the groups that make this a broad rally, and I like a broad rally. So you know what? We're cruising for a suboptimal situation. Make money tonight. What's ahead for Pfizer amid a potential shakeup by activist investor Starboard? You're not going to want to miss this interview because it is going to be, well, I mean, if you care about business news, it's the right place to be. How about that? Then, is shaky foundation eroding the housing sector? Like I just said, I'll reveal what recent earnings reports are signaling in the current rate environment. And Reddit climbed to a 52-week high today after the report, as I mentioned. The social stocks top brass joins me fresh from earnings, and I know you won't believe me, but my cappuccino today was decaf. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.